everyone. Nice to see you all. My name is Dina Tsarapkina. I'm the co-founder and co-chief investment officer of Syncretic Capital. So we're a cyclical multi-strategy crypto hedge fund. I used to work at Bridgewater. I worked on the unofficial crypto team there, working on educating Ray Dalio on his views on crypto. Worked for one of the other CIOs. So I've been in the TradFi space for a little while now. And mostly I wanted to go through the really boring topic of risk management. So none of you actually want, none of you want to hear this, but unfortunately I think some of you may have to. So the funny thing about the crypto space is by the law of large numbers, a lot of people made some very concentrated bets in the space, and then some people got very lucky in doing so, and so ended up with a lot of assets. But unfortunately, applying these very concentrated bet approaches towards asset management puts you in the position of being more likely to lose all your investments rather than actually being able to preserve your wealth. So I'm basically here today to talk to you about some basic guidelines on how you may want to change your current holding strategy in order to increase your chances of preserving your bags. So volatility is, in crypto, a really, really big factor. And the way that it works in this space is very different from how it works in TradFi. So generally with volatility, there's a lot of, I guess, nuances that end up being approximations when you're working with low volatility environments. But when you're dealing with really volatile assets, there's some things that you may want to keep in mind. So as Caroline Ellison said, you can only lose 100% of your assets, but you can gain infinity. Unfortunately, this has some nuances that we should probably think about more explicitly. So basically, I think one thing people fail to realize when dealing with volatility and investing in highly volatile assets is that if you lose 50% of your assets, you actually have to make up 100% in order to regain your initial base. And so I think that people in crypto kind of don't really appreciate this asymmetry. And when you're dealing with things that aren't particularly volatile, this nuance doesn't really matter, and it ends up being a rounding error. And so, traditional finance principles don't really emphasize on the asymmetry of geometric returns. But I think it is something that's worthwhile considering as you're, it is something that's worth considering just as part of, when you're making very, very concentrated moonshot bets. So diversification. So everyone's heard about the mythical 60-40 portfolio, how it's been broken, all this boring stuff. But in reality, if you're dealing with several different assets, having them being uncorrelated adds a lot of value to your ability to preserve wealth, because the various return streams, if they are in fact uncorrelated, will reduce your losses. And how I mentioned in the prior slide is if you basically are in the position of experiencing an extreme drawdown, you have to have much higher performance in order to get out of the hole. And so diversification allows you to have different uncorrelated cash flow streams that have similar return streams, which doesn't really change your expected performance from a purely expected returns perspective, but it does increase your overall Sharpe ratio by reducing your volatility. So being able to allocate your portfolio and placing your assets into uncorrelated cash flow streams will go a long way in terms of wealth preservation. Just because things have the same expected value doesn't mean you're actually going to realize those returns. And so decreasing your volatility increases your odds of actually being able to realize those expected returns. So to the extent that you can diversify your holdings, please try to find uncorrelated assets. And so sources of diversification are quite hard in crypto because everything is really, really, really correlated. But with a little bit of creativity, you can try to diversify your assets a little bit. So one really simple way to think of it is in token allocation, you may want to invest across various different chains or different themes, whether it's GameFi and whatnot. But unfortunately, most of these things are going to end up being really, really correlated regardless. And so to the extent that most of your assets are actually in token exposure, you are going to experience a lot of correlation. Like most of these things are 70 or 80% correlated, so that's not going to be too good for your diversification. But if you look at some more creative sources within, the crypto space, like obviously yield farming is one aspect of that. There's some synthetic instruments that give you exposure to gold, for instance, PAC-Gs, like pretty diversifying and inflation-protected exposure to gold. This space is still developing, but to the extent that you can find kind of things that aren't really organically driven by the same factors as generic crypto tokens, that will be pretty valuable in terms of sourcing potential sources of diversification. Another thing that's worth touching on is option vaults. So people think that this is like a really good source of diversification, and it can be, but a lot of the time you actually can't take both sides of the vault. And so you should really think about like who is the counterparty that you're betting against in the space. Why would you trade a market where you can't take both sides of the bet? These things are really designed in order to trick retail investors potentially into putting their assets into these things that has a negative expected value. So while they might be diversifying, they are sometimes negative expected value. And so just be careful playing with any kind of markets where you do have a place where you can't take both sides of the bet. So hedging instruments. Most people think derivatives are designed in order to take concentrated bets in crypto. So you see a lot of people trading like levered perps and options and all these things to get convexity. But crypto people would be surprised that they're actually designed for risk management. So I'm going to walk you through a couple of different ways that these instruments can be helpful with downside risk mitigation. The couple disclaimers that are worth noting, though, is that volatility in crypto is very, very large, which means that hedging your risk is expensive. And you do want to be thoughtful around when you're actually spending the money in order to hedge your portfolio, because otherwise this can get very expensive. And the funny thing with options is that whenever you need them most, they're actually the cheapest. Because when is the crypto market the most fragile? It's at the top of the bull market. When is the market most likely to collapse? At the top of the bull market. And people are mostly using options to make concentrated bets on the upside rather than trying to hedge their portfolio. So to the extent that you see volatility is really cheap, ask yourself, like, why? Is this because the market is overheating? That might be a good indicator that it might be worth putting on a hedge. And of course, the same thing is true with perpetuals, right? Like when perpetual borrowing rates are really overheated, that's also probably a friction that you may want to think about. And it's, perpetual yields are high when things are overvalued, when things are stretched. And so that's a natural gravitation force for maybe what goes up is going to come back down soon. So hedging DeFi exposures. A lot of people don't actually think about this, but to the extent that you're allocated into a liquidity pool, you can often hedge some of those exposures by going into the perpetuals market. So you do have to think about the cost of hedging. The baseline hedging rates on perps are about 10% a year. Maybe you're in like a stable volatile LP, but you can usually hedge at least one leg of the trade in order to get protection from the downside. So this way you can potentially experience the gains from a yield farm without necessarily having the volatile exposure of having the actual underlying exposure. And so that's another potential source of diversification, because a lot of the benefits of yield farming are that you're getting a yielding instrument, and being able to remove some of the volatility does reduce your correlation and kind of creates something that looks like a bond. So leverage, liquidations, and capital efficiency. So when you're hedging DeFi instruments, there is a factor of dilution of yield that happens. So to the extent that you're spending capital on both deploying it into the farm and also having to put some capital aside for hedging, that's going to basically dilute the total amount of yield that you're getting on your deployed capital, because you're having to hold collateral against some of the perpetual instruments that you're deploying. And so you do have to think about what you're actually earning is going to become less than what's quoted in the yield farm. You're going to experience impermanent losses. You're going to dilute your capital by having to hedge. And managing those positions, potentially you can put on a leveraged perpetual position and hedge that way, but then you're more at risk of blowout. So these are all things that do require very, very active management as far as, Anyway, capital efficiency and hedging does impact your total return, so that's one more factor that's worth thinking about. So why liquidity matters? A lot of people end up, I mean, for the most part, in retail investing, it doesn't matter too much because you're usually not a huge mega whale that's going to, move a liquidity pool by pulling your capital out. But in case there are any people with really, really bags here that like to take concentrated LP positions, it might be worth thinking about what happens if you try to really quickly exit everything you have in a single go. So often you want to exit liquidity that not going to exist. And so think about what share you are of any liquidity pool you're participating in. Think about the overall liquidity of the market you're trading in. Think about what happens in the event you want a stop loss to be working, because a lot of the time, when you think you want these things to matter is when you're going to basically get rugged and the market's going to fall out from under you. So again, just useful things to think about as part of your day-to-day process of putting on what you think is potentially a hedge or potentially responding to bad market conditions and how to do these things in a responsible way. So beta, this is not, I don't know if generally, do you guys know what beta is, market beta? I don't know. No? We don't know what market beta is. Some do, okay. So beta is basically a function of correlation and volatility. So how related is the market that you're dealing with to other markets? So within the crypto space, like your betas are going to be generally quite high. When you're dealing with shitcoins, you're going to have both really high correlations and high volatilities. So effectively, when you're trying to trade, when you're holding shitcoins, you're just basically getting like 90% really levered Bitcoin or Ethereum. Then there's beta with TradFi markets. So TradFi markets actually also have parameters that influence the crypto markets, and there's times that that matters, and there's times that that doesn't matter. And so really understanding what factors are driving the market, whether it's risk on, risk off dynamics coming from equities, whether it's bond yields, understanding how these pressures are impacting crypto at any given point in time allows you to have some potential power over how you can actually use some hedging tools in order to reduce the risk in your portfolio. So, the calculation of beta, anyone can Google, it's really easy, but basically the important thing here is understanding when risk events are happening in the crypto space and basically considering hedging either using options or perpetuals at a time when those things are actually at high risk, and potentially you might not want to liquidate your whole portfolio ahead of a risky event, but that's really when tools like perpetuals or options might come in handy as far as hedging goes. And that brings us to the topic of hedging event risk. So for instance, like if JPOW is giving a speech of some capacity and the market is really nervous about that, you're going to experience volatility within the equity markets. And because crypto is way more volatile than equities, there's potentially going to be a big shock to the crypto markets that flows through that. And if it really is a pivotal Fed announcement, it could really change the direction of the crypto cycle. So if stocks are going to tank, there's a chance that crypto will get even more hurt by something that JPOW says. And so, potentially hedging for your portfolio and understanding how much you want to hedge your portfolio by knowing your portfolio's beta ahead of these announcements basically prepares you to experience some of that volatility in a less, painful way through the event. And so that's another place kind of where you might want to think about understanding the composition of your portfolio, understanding the volatility, and just being well prepared for deploying some hedging instruments against periods that might really injure you. And leveraging data. So in order to do all these various things that I described, you probably are going to need some data. So here I'm going to insert a small shield towards some of our counterparties that we like to use. So there's Arkham Intelligence if you want to monitor on-flows things, Crypto Quant or Glassnode just in terms of various kind of on-chain aggregations, Delphi Digital for some research, Amber Data for general market data we found quite useful, and the Tai and Masari we find useful resources for kind of general like Bloomberg-style insights into the space. And that's mostly all I have for you today. If you thought any of this is confusing, you should just hand your bags over to me, and I will manage them for you. So that's mostly it. Thanks a lot for taking the time to listen to my talk.